Everyone, and welcome to our webinar today. So today's webinar is about the all-weather portfolio, something for all seasons. Our panelists today are Swapnil Mishra, who is Kristal.AI's head of private wealth. We have Thomas Michael with us, who is our head of advisory. And we have Hilda Tam with us, who is our user journey specialist. So just quickly about this webinar, this is your chance to ask our experts any questions that might be on your mind. So please use the Q&A tool. So you find a little icon with Q&A either on the bottom or on the top of your screen. So use that to type in all of your questions anytime. And if there are any questions left, please feel free to send them to support@Kristal.AI. We will always be happy to answer your questions as soon as possible. Finally, this webinar is being recorded, and this is just for your information, and we will also be sharing this recording afterwards with all of you, so you can revisit it and of course share it with all of your friends. And without further ado, Swapnil, maybe please kick off this webinar for us.
Thank you so much, Barbara. A very good evening to everyone out there, and at least in Singapore, the circuit breaker is extended. So we know that we are going to be staying home and staying safe. And the number of webinars is increasing, and everyone is trying to do their bit in terms of sharing new information and trying to make it, in whatever way possible, more diverse and maybe more information. So we thought that, okay, let's also look for, for more talent to help us do that. And I've been there, Thomas has been there, we've been there in the last few webinars. So joining us this time, of course, for the first time is our user journey expert, who's Hilda. She's just joined us about 2 months back. She was one of the original co-founders of the, one of the top cocktail bars in Singapore called the Spiffy Dapper. She's won a lot of awards as well in the space of bartending. And she decided that she should bring her values of personalization, curation, and hands-on approach, a lot of which kind of intersect with Kristal as well. And she joined Kristal.AI, and she leads the client user journey in the organization. So, and since it's the first time she's joining us over here, I might as well put her in the spot and ask her that, how is, Hilda, how's your personal investments journey been with us? Has been in the past compared to the journey of clients at Kristal?
So like my personal experience in investment was actually the bar business. So that was my very first without any experience. So I kind of just dived in and had a very hands-on approach to everything. But when I left the business and joined the workforce, I decided to start like investing in finance. So I read some books and asked a few friends who are investing. That is how I got started in ETFs. But when I joined Kristal, my perception changed because I realized that there is a need for more balanced portfolio. And as amateur as it sounds, when I first started, I didn't realize the difference between asset classes and what happens to it when the economy changes.
Well, that's so true in terms of asset class change and the impact when the conditions change. And if you take a very simple analogy and imagine if you went to a park and it's a very sunny day, and luckily right now, at least in Singapore, it's sunny, and there's somebody who's set up a stall and selling sunscreen, and it's extremely sunny. So do you think you would invest in that business venture, Hilda?
Yeah, sounds like a good idea.
Yeah. So on a sunny day, it's a great idea. And do you think you would want to invest in another stall at the same place which is selling, let's say, raincoats in the park?
If it's during summer, I think the chances of the raincoat selling out is not likely. So I probably not want to invest in the raincoat.
That's totally understandable.
Yeah.
So here what has happened is we've looked at the current condition of the weather and said, hey, it's sunny. The forecast is also sunny and it's summer. So let's invest everything in the sunscreen business. And who knows, the weather suddenly turned, there's thunderstorm, clouds and rain. And you have people queuing up to buy umbrellas, and the entire business for sunscreen has been shut down. Now, of course, it's an oversimplified analogy, But what it highlights is that different businesses, or for that matter, different assets, are dependent on outcomes, are dependent on the seasonality or the economic condition. And in many cases, that condition is out of control. So for the person who's selling sunscreen, doesn't control whether rain comes or doesn't come. And similarly, for different asset classes, the asset classes don't control how that happens, what the outcome is going to be. So what ends up happening is there is an attempt to cover various asset classes. So in this case, I would want to invest in something which is the sunscreen equivalent, which works in a sunny weather, or in the raincoat equivalent, which works well in the rainy season. And from an economic point of view, or from the investments point of view, how do you achieve that? And the person who kind of pioneered this thinking was Ray Dalio, and created something which is called the all-weather strategy. Thomas, how would you describe the all-weather strategy in terms of how it works?
Yeah, so all-weather strategy, as you said, it's building a portfolio that is suitable for a number of different scenarios, and that's not only performing well when the sun is shining, or some strategies do well when it's raining. So that was the initial thought of the inception. If we go back in the history of it, if you think of the 1970s, when this strategy originated, what did we have in the 1970s? In the 1970s, so we went through the 60s period, which I compare it a little bit with what we have gone through over the last 10 years as well, over the last decade. Extremely low interest rates, relatively steady growth market has been just trickling along. And then the 70s started with a big bang in the beginning, when Nixon dropped the gold standard. Yeah, and that suddenly caused these changes in the, I would say, in the economic fabric, in the economic framework, where you had suddenly bond yields rising, equity markets selling off, or at least not offsetting the buffer from the bond losses, and it put a third asset class into the fray, which is sort of like the hedge for inflation, and that was the commodity portion and allocation in an all-weather portfolio. So this has been tried and tested over time, and I think that the main philosophy, or the core philosophy behind it, is that an all-weather portfolio should give you, or shouldn't give an investor, a return that is in excess of the average long-term growth rate of GDP, for example, and that's driven by the relation between the three main asset classes in that portfolio, which are equities, fixed income, and commodities, or gold as a store of value. Yeah. But even then, even though it was a portfolio that was built for all-weather scenarios, even the last 10 years that we have been looking at this, since until October 2019, the portfolio showed a 7.65% compound annual return. So it has also performed very well in times when market was steady and was performing in a relatively strong fashion, with returns driven by equities and fixed income.
And I guess in terms of the various, in that entire time period, there has been, there have been many seasons. So you've seen periods of high growth, you've seen periods of slowdowns, and a diversified approach, which means investing a certain combination of those assets in terms of proportion for an outcome which is most optimal. So of course, one can take a strategy that you invest equally in all the assets, which may not necessarily be the outcome, the optimal allocation.
Yeah, that's correct. So if you think about the all-weather portfolio, it's working based on the intercorrelation between these three asset classes. So when I said earlier on that what are the performance in excess of GDP growth. So let's look at the factors that affect the asset value. We have here, of course, rising growth, declining growth. And then we have inflation and deflation as the main drivers that are driving asset values. Now, in an environment where you have rising economic growth, what happens usually is that your equity markets are performing extremely well, and your commodities are also performing usually well and at a higher rate, because there is a demand for materials, for metals, for energy, etc., just to keep the growth or keep up with the growth that's happening in the market. Whereas bonds don't tend to do as well in a normal environment, and get later to what's normal, what's not these days. But in a normal environment, because central bank would try to keep inflation in check as well, and would naturally start to raise interest rates at some point in time, and that will lead to higher bond yields, and due to the inverse relationship between yields and prices, that would mean then bond prices or the value of the bonds in your portfolio would fall. That would be offset by a rise in equity and a rise in commodity. On the other extreme of the spectrum, in a period of lower than expected economic growth, and that's also something that we have been in over the last couple of years. We have seen central banks keeping rates at record low levels and reducing them even to negative territory in a lot of large economies globally. And that in a normal environment, again, in a recession, equities don't tend to do that well. And that increase of bond prices would offset a buffer for equities. Now, we have gone through a very extraordinary time period the last 10 years after the global financial crisis, where actually the correlation between bonds and equities have gone positive. And that has led to a strong performance at both ends. And that's why we have seen, that explains that high return in this all-weather portfolio, far in excess of economic growth that we have observed over that time.
No, that's absolutely. And as you rightly said, the conditions have become, new normals are being tested and we're being challenged on an everyday basis, especially in the last few months. Who would have thought Coldplay would be doing a performance on Instagram and canceling their shows? So this is not normal. Covered various scenarios, and Hilda, I think this is where I'll put you on a spot and I'll ask you. I'll quiz you on the deflation versus inflation versus stagflation. So, just kidding. We've spoken about a lot of things: asset allocation, diversifying for different macroeconomic conditions. What do you think in terms of? Do you think it's too early to join the finance, and you would love to go back to food and beverage industry?
Not at all. Yeah, I really enjoy what I'm doing here. And of course, I find similarities between making a cocktails and of course putting together a portfolio. So this is where personalization comes in, which is like on the consumer side, like how sweet or how sour you like is equivalent to like how much risk and volatility do you want or can handle, and it's influenced by your personal preferences and experience, which to me I see it to be the same as like the risk profile, along with factors like age, time horizon, and risk appetite.
That's amazing. Yeah. Actually, that is really, it's amazing to draw a comparison with the element of personalization and constructing a cocktail versus a diversified portfolio. Thomas, going back to you in terms of how would the philosophy look like in terms of an all-weather risk allocation?
Okay, so the classic philosophy has, in terms of broad allocations between those asset classes, a breakdown of about this slide here. Maybe we can switch to the next slide. This is showing our current. There we go. That is the classic risk allocation philosophy that we have. The textbook allocation. So it's about 7.5% broad-based commodities, about 7.5% in gold as a store of value. So that takes care of your commodity part of it. So hedge of inflation, so to say. Then we have about 40% in long-term bonds and 15% in intermediate bonds, and 30% of the portfolio in equity. Yeah? That's what the textbook says. Now, I would like to point out as well that, as I said earlier, or I hinted at that early on, this is what it should look like in a normal environment. And by the definition as to what is normal, I think even an all-weather portfolio needs to have a certain amount of mental flexibility. And we also need to react to changes in the circumstances and into the market environment. So brings me back to the history of the all-weather portfolio. When it came up in the 70s, at that starting point, long-term interest rates in the United States were at about 5.5%, and they moved through that inflationary period of the 70s. They traded as high as 20%. Yeah? Also unprecedented, the same way how we are unprecedented now at the zero boundary interest rates. And I think models need to adjust to that as well to a certain extent to reflect those changes that we have in an all-weather portfolio. So it's not something that I would say personally, it's a one-size-fits-all. We also have to keep a dynamic flexibility, and that goes kind of like to Hilda's example about is it a little bit sweeter, or do we have to be a little bit more sour with our cocktail right now? And that's where I think it's important to, even if you have an all-weather philosophy, be mindful on in what environment are we. Yeah. So yeah.
But then,
I can show also based on that that if you look at this slide and if you look at what's the allocation that we have in our Kristal all-weather Kristal as an allocation, you can see there's minor changes, yeah, but changes nevertheless. Yeah. So we have increased our allocation to commodities and gold at that point in time. Targets to reach at about 20%, so over allocation of that segment, and at the same time reduced the allocation to long-term bonds. And that's purely a consequence of the zero boundary of yields that we are reaching. Our analyst team has been looking into the similarities that we have in the history in similar, I would say, anecdotal cases. And for me, the event that I have picked out here as a comparison is Japan in 2011. So 2011, Japan was also trading already at zero rates, and the Bank of Japan has been trying to stimulate economy for many years already. Yeah. What happened in 2011 was the Tohoku earthquake with the subsequent Fukushima disaster, which caused a drastic slowdown and really a shock to the Japanese economy as well. And similar reaction to what we see today in the US, it was that Bank of Japan started to monetize their bond market and broaden the amount of bonds that they have bought, etc. And then looking at the analysis, how did an all-weather portfolio in Japanese terms would have performed over the next 10 years or 9 years in that case, was that it pointed clearly towards a higher allocation for commodities and at the expense of a lower allocation to fixed income. So that's kind of like our reaction to that. Then also one of the questions that we received in the QA was about how do we rebalance an all-weather portfolio? And I would say yes, absolutely. I think it's important to stick to the plan. We spoke about it in earlier webinars as well. Important thing is asset allocation, so that's what we are achieving with that. Second one is have a plan. The plan is to stick to that asset allocation as much as possible. And these allocations, they move around. They are variable. It's just driven by pure function of the prices of the assets within it. And we have seen this in March with the steep sell-off in US equities, that our equity allocation in the all-weather Kristal has dropped to quite substantial levels below the target allocation. And be it by sheer luck of the timing, we were able at a time around the 20th of March, that equity allocation has dropped below 25%. And we have reallocated, and we have sold some of the fixed income in that Kristal and bought S&P 500 ETF and have brought it back to the target allocation, and enjoyed that rally on the way up. So it's important to maintain a certain activity in that and to keep it within that. Don't overtrade it, I would say, or we're not looking to overtrade it, because there's a trade-off between the commissions and everything, and the cost of reallocating. But it needs to be looked at, and that's the convenience that we can offer as well through our Kristal, because we are maintaining it and looking at it at regular intervals.
I think we have already started receiving a lot of questions. Thomas, do you want to cover the Kristal, or should we just start answering some of these questions?
Yeah, absolutely. I think one question is about the whole all-weather strategic allocation for the next 30 years. So the last 30 years have been a period of decreasing interest rates, double-digit stock returns, and the next 30 years rising interest rates and mid to low single-digit stock returns. I think this is kind of like also going back to the earlier comment. I think consequence is that the commodity allocation is going to increase, and to look at stores of value like gold, for example, that will offset the buffer from rising interest rates at least.
Yeah. There's one question which is around whether how to participate in this fund, and whether one can just buy this fund and is diversified on its own already. And I think that's where our the unleveraged Kristal, if we can just show that, Barbara. So we have the Kristal all-weather US unleveraged, which is available. It tries to implement that same philosophy. And there is some element of rebalancing, and as Thomas explained, it aligns with some of the fine-tuning with reference to the economic conditions, but otherwise tries to follow the all-weather recommendation. So yes, it is possible to just buy something like an all-weather fund or an all-weather Kristal, which is there. There's one question, Thomas, which is very interesting, because I remember you posed this question, the impact of current low yields on long-term treasuries and long-term returns for the all-weather portfolio. I mean, it's eerie. I almost feel as if you typed this question. It is a challenge. I don't know, Thomas, how are investors going to address this problem, or this challenge rather?
Look, it is really a tough one. I mean, no, it brings us back to the same point. Okay, I think we have different. I try to not to get too technical, yeah. But I think the key is with first of all, my paradigm has changed in a way that I'm a child of the 80s and 90s. For me, it was impossible to think that rates will ever. It's possible that the interest rates go negative. Well, lo and behold, it didn't. It was just not too long ago, and we had about 1/3 to half of all sovereign debt issued globally trading at negative rates at a time when pretty much the entire European Union and Japan was trading at negative rates. So there is a possibility. I wouldn't say that there's a probability higher than zero that this might also be something that could happen in US Treasuries. We don't know. Yeah, it's a very tough call to make. But what happens, and that's the technical aspect of it, is what happens that at the zero boundary, there is this funny thing with bonds and fixed income that's called convexity. So I've said you have this relationship between prices and yields. So when yields drop, prices go up, and vice versa. Now, the convexity, the lower the yields go, the more diminished is your impact of the convexity on the bond portfolio. That means you are actually forced to your changes in prices are going to be magnified, yeah, in a large extent. So what it means in our model is that you have to. It is a better outcome if you're reducing your fixed income allocation based on that, because your offsetting factor that you would have had in the past, that you would have in a normalized environment with rates at 5% or 7%, then you're getting more of this transmission of yield into price. And that's happening less so at this lower level. So with 1 basis point change at a bond that is trading at 0 yield, your price change is higher than that. So you need to go a little bit easier on that part here.
Yeah, that's true. There's one more question, which is talking about the fact that things are very volatile in the current environment in most countries, and looks like we may head into a possible recession. Would this strategy be helpful in something like that?
Yeah, maybe can I, Barbara, can you change the slide that shows our performance of the all-weather Kristal over the last year? So yeah, thank you. So this chart shows we've made a comparison to a classic 60-40 portfolio. Yeah, so 60% equity and 40% fixed income, which is also very popular from a passive investment strategy. Yeah. And you can see it clearly dampens. And we've taken the period between last year, April, and this year, because we have gone through various views, and particularly the period last year, July, stands out, where the market, I remember last summer, when half of the world was expecting, oh my God, the yield curve go inverted, we might see a recession and so forth. And here in this portfolio, it has done extremely well because the long-dated part of the portfolio has supported the performance. And that's something in a recession scenario, again, at the moment we are trading, I would say, on a relative basis, the yield curves are extremely steep. If you think about it, US interest rates are at 0 to 25 basis points. That's the current Fed benchmark rate. In the 30-year, we're still trading at about 124%. So in absolute terms, you're getting manifold your returns in the 30-year compared to the short end of the curve. So yes, there is some view that I would say there is an offset also in a recession scenario. Yeah? But it is not, unfortunately, it's not all the portfolio that solves all the problems. Yeah, there will be, as we have seen largely last in March. I think the killer with an all-weather portfolio, but it's a killer pretty much in any portfolio, is when correlations go to 1. So this portfolio works well based on the correlations of the different asset classes to each other being different. But if you have a period of extreme deleveraging and market going into a stress scenario where pretty much everything gets sold just to liquidate it, that's a period that we have been through in March this year. You saw days where treasury bonds were down, gold was down, and stocks were down. And in this scenario, the only remedy is cash.
Yeah, I think that's the example where correlation turns to 1, which means the entire foundation of any diversification principle is that different asset classes work well in different conditions. We've always seen situations where, of course, in very rare cases, but it does happen that the correlation becomes 1, which means all asset classes are suffering or being sold off, and the only asset class which everyone wants to hold is cash. So we're seeing a couple of questions which have been asked around impending recession and the impact of a strategy like this. So I would say, as Thomas mentioned, the diversified or the splitting across different assets does help. You may see short bouts where all asset classes behave in the same manner, but for it to happen on a sustained fashion is something which would be extremely difficult to manage, because it would mean that everyone just wants to hold cash and not spend at all. The minute spending comes back, you're talking about growth coming back, even if the growth is small, spending and growth will lead to some element of divergence in terms of the correlations. There is a question.
So, yeah, speaking of correlations, there's actually one question from Mikey I would like to take also live on the webinar here. So the question was, would it make sense to add credit risk to an all-weather portfolio? And the reason why I'm taking this question now is when we talk about correlations, there is a component with credits. So this is, I assume that the listener is asking about credit as a fixed income component. Now, there's also a correlation between credit spreads and equities. So would it make sense? I would say on the very, only the highest type of credit quality, because otherwise you are running the risk that you are creating a positive correlation between the credit bonds and the equity portion. So you are diminishing that offset here. So I would say in the strictest sense for that purpose, no, or if it has to be credit, then it should be something in the supranational or sovereign credit. That's something where we can diversify, but not a credit. Don't play with high yield or corporate credit, because corporate credit, if there's a recession, corporates do get downgraded and do have every now and then the nasty habit of defaulting on the debt as well, and that can ruin all the assumptions of offset from a fixed income portfolio.
Yeah, it's true. There's one question around comparing it to the US. So does an all-weather strategy have to be only US centric, or can it also have developing or emerging markets as well?
That's a great question, actually.
I guess liquidity is one element around markets. I mean, what kind of assets are available?
Yeah. It's a fantastic question, and to be very frank with that, I've dabbled with that question a lot in my mind, and with playing around with some models. I have to say that in the emerging market space, it has not worked out, and the reason being that we have a US centric all-weather portfolio in there. The reason being is that there is a currency component in that as well. So, for example, for commodities which gets priced and traded in US dollar, there's a huge currency component for emerging market economies. Yeah? If you are not able to print your own currency, or if you're not in control of your own currency, there are every now and then events that are just devastating for all-weather portfolio. If I try to replicate, let's say, for example, in Indonesia or in India at a local basis. So those, there's very inconclusive results. Yeah, but in developed economies, it can work. Yeah, so I've made earlier the example with Japan. So we looked at it from a Japanese example. That was possible for to replicate all-weather in Japanese yen. It's also possible to replicate it in euro, for example. But again, I think the important part here brings it back to the earlier comment about mental flexibility of allocations. I think that a all-weather portfolio in Europe would have to look very different than a US all-weather portfolio, given that you are trading at minus 75 basis points for German bonds. Yeah. And that makes it a bit different here.
Yeah, we have one question on lump sum versus monthly investing, which I think it's more a function of how you want to allocate the risk. Given that this is something which is diversified, it is possible to start as a lump sum because your equity allocation is still going to be 30%. However, if your capital that you are allocating based on your profile is for a larger equity allocation, then you may want to do a monthly investment, but in a higher equity or a higher risk category. Both the options are available depending on your risk profile, and also depending on your time horizon that you have for the assets that you're putting aside. There's a question on comparing it, the all-weather, to the catalyst. So we have something called a catalyst as well. In terms of asset allocation and rules, Thomas, how would that compare?
So for Catalyst, it's about the 60-40 allocation with the difference on that. We have used the Catalyst in the past or we are using Catalyst also more to reflect what the algo is selecting. plus what we are getting in terms of signals from the from our models on specific sectors. So I think Catalyst has a bit more of this credit component. It has more of a specific sector component in there. The all-weather is really focusing on treasuries, on broad indices, and commodities. So you are eliminating the sector risk. You are eliminating credit spread risk in all-weather.
Yeah.
So a Catalyst, I would say, if from a risk profile, is a higher risk profile. Is a bit more of the turbocharged version of that. And you don't have the commodity component in there at all times. We had last year, I think it was about October, we did actually add gold into Catalyst at some point in time, and then like towards the end of the year, it was again removed from the model. But it's not a guarantee that you will have a commodity component in Catalyst at all times.
We have a few. So there's one question, which is how liquid is this, and can there be a bank run kind of situation? I mean, we saw the run on liquidity in March, where suddenly everyone was selling everything, and at least in some places where we saw, for example, in case of Fed stepping in for LQD and providing the liquidity in the market, so that you don't have only sellers and no buyers. So we are seeing central banks more alert about liquidity. Having said that, ultimately these markets or these underlying ETFs are dependent on a normal functioning market, which means at any point of time there need to be some sellers and some buyers, and hence both have the opportunity to trade. I don't think it's a bank run, but yes, you may have a situation where low liquidity is reflected in the prices for the underlying ETFs or securities. Anything next that you want to take?
Oh yeah, there's one question from Nippon about what is in commodities. So for our all-weather crystal, we have chosen for commodities exposure is the it's a broad-based commodity ETF, which is the Invesco DB Commodity Index ETF. That has exposure to a broad spectrum of commodities. So you have everything in there from energy to precious metals, industrial metal, agricultural commodities. I personally think that that's the right approach. You can also have an all-weather portfolio purely with gold, but I think gold is starting to get its own life at times, as we have seen. It's less correlated with the underlying economic activity. Therefore, in terms, it trades different from the broader commodity space at different times. So I think the classic to have a broad-based commodity index. And that also ties up into one question about the allocation between equities, tech, finance, healthcare. So again, I think all-weather portfolio should be as broad-based as possible, because you don't want to worry about specific sector risks. Some sectors do better in some economic cycles, like at the moment, with the view on impending recession. Our view is more constructive on something like consumer staples or healthcare, given with what's going on. And at times when growth starts to turn around and we see a heavy rebound in the economy, it might be better to go back into consumer cyclicals. If it's and I think this is to some extent what Bridgewater is trying to do or is doing in their portfolio. They are weighting their equity allocation with sectors as well, which gets you a little bit of a turbocharge. And then again, I mean, I'm not a PhD, and we try to keep it simple. We try to keep we try to keep the expected the actual return as close to the expected return as possible. So I don't want to leave too much room for experiments here. And then it also would go at the cost of tradability in terms of the size that you have here. If you have a large portfolio, then you can start to do these things, but to press it or to put it into a crystal that is about $1,000, $1,200 of notional value limits your ability to get too cute about sector allocations and so forth.
Okay, don't want to interrupt you, but I just saw that someone raised his hand, who is Ashish. So Ashish.
Let's let our CEO in.
Yeah.
Hi, Ashish.
Hey, hi. So I just wanted to, highlight and just see if you want to touch upon the fact that we use ETFs and not exactly a fund. Because of the liquidity aspect, I think we want to highlight that it's quite easy to rebalance, whenever the rebalances are triggered. So do you want to just touch upon the fact about the ETFs being used in it?
Yeah, sure. So our all-weather crystal, thanks for the question. I think it's important. And it also kind of like ties into the question about the bank run, etc., and liquidity concerns. So we are using liquid ETFs only for that. And these ETFs with underlyings of US Treasuries and broad indices, they are screened for daily liquidity, bid-ask spread, and of course the management fee as well. So really trying to keep this as liquid as possible. We want to avoid situations where we can't get a bid for a bond or these kind of things. And that gives us the advantage of really having daily liquidity for these assets to serve redemptions or subscriptions. Yeah.
Thank you. Yeah, so it's daily liquidity, right? That's, I think, important to highlight. Yeah, that's a good one. Thanks.
Okay, so one question from my side to Swapnil and Thomas. So is your private portfolio actually following all-weather strategy? And if not, what are the biggest differences compared to all-weather and why?
I take the answer first, and then I may take a break and let Swapnil. My answer is yes.
Yes, you are following all-weather?
Yes.
Okay.
Yes.
Swapnil.
So I'll be honest, I'm struggling to do this on my own and trying to say that I will maintain the diversification. And in fact, sometime back, Hilda asked me this same question in terms of why would somebody use an all-weather? And the honest answer is that if you are able to do it yourself, it's great. But if you're not able to do it, then I would like to use the all-weather fund or crystal to achieve that element of discipline in terms of just the ingredients coming together and creating that portfolio rather than trying to do it. So yeah, so the answer is I don't, and I would love to.
So to expand on that one, and then maybe that's a little bit more differentiated from my side as well. We've been talking about portfolio construction as well, and the way how I think about not only my portfolio but also about our client portfolios is always about this core and satellite. Like, what is the core allocation of portfolio, and what is the tactical satellite allocation to that? And for me, my core in the portfolio is the all-weather. I don't want to worry about it. I just want to be able to sleep well and say this is kind of like where 75% of my allocation goes into, and that's what I'm sitting on. Yeah? The satellites, then the tactical allocation, that's something that gets taken care of with other strategies that I like, whether it's a foresight or some sector ETFs, or just using the algo on a regular basis to rebalance my portfolio for that other 25% of it, and say that's kind of like let the algo be my driver and follow that allocation. So that's kind of like for the remainder of it. Let me just go through the list as well. Any other questions? was one question, how is it compared to steady growth? And also one question about the minimum size. Maybe that's kind of like for the two of them together. So the difference with steady growth is clearly that steady growth is like 60-40 portfolio. Is built along this philosophy. There's no commodity component in a steady growth Kristal. And then also with regards to the question about the buy-in at 1,200. So that is something even if you ask me personally, even 1,200 is sometimes a challenge for us to manage it effectively. That's not so much because we don't want to, but we do have, unfortunately, some limitations by our partners in partner brokers about minimum order size and exchange fees, etc. So that's a certain limitation. If you have a larger number of assets in the portfolio, then it requires a certain minimum amount of it. But we are also always looking, if things change and we are able to offer it in smaller pieces, then we will certainly look into that. So that question is also taken as a constructive feedback, and we will take a look into that if we can do this. Yeah, but it will limit our ability to rebalance. That's what I have to say with this. Yeah, it's kind of like
that's I guess that's the trade-off between achieving the minimums and achieving the ability to rebalance with the underlying ETFs. So yeah, so we've covered a lot of ground today in terms of the all-weather strategy, how to go about answering questions. Hilda, anything you want to share, or based on what all we have discussed today?
Well, we have a cocktail in the topic, right?
Yes.
Yeah. So we actually prepared like a cocktail recipe for everyone to try out, during gathering when this CV period is over or something. So I was really inspired to join this webinar with Swapnil and Thomas, because when I first saw the Ray Dalio's chart, I was very surprised to see that I could connect it with my own Negroni Spritzer recipe. So the thing about Negroni Spritzer is that most of the recipes would call for blood orange or orange juice. And if for someone like me who loves Negroni, I don't want to mix juices into my Negroni. That's a thing. So I thought about like, how about a hybrid between like an Aperol Spritz without champagne, but with Negroni. So this is my very own recipe that I've tested out, also served customers with it. And yeah, so it's just a little something for you, everyone, to remember more about all-weather. Yeah.
And Hilda, I have to compliment you. You have already fully ingrained the financial industry by putting a disclaimer as well at the bottom of your recipe.
Yes. Yeah, because it's a bittersweet cocktail, and I guess some people don't like bitter stuff. So.
Yeah, Barbara, I think we can
wrap it up here.
Yeah, we can wrap it up. Some of the questions, I think Barbara just sent it to us. We'll try to get through those by email as well.
Exactly. Exactly. I was just about to say there are a couple of unanswered questions left, but we will make sure that all of the questions get answered, and I will follow up with an email and send the answers to the other questions. As well as I will also send the link to the recording of this webinar. And like one request, maybe if you have any ideas, requests on the future webinars. So what is it that you would be interested in hearing about? Any topic that comes to mind. Please just respond to that email or any email that you got so far regarding this webinar. And yeah, it was great having you here, and thank you very much to our panelists today.
Thank you.
Thank you. Bye.
Thanks, everyone. Bye.